Hello everybody, my name is Lance Martin with Coldwell Banker Town & Country, and I want to thank everybody who attended our 2015 Market Forecast event. Specifically our sponsors, Alpha Graphics, First Lending Solutions, and Mountain West Financial. We also raised a little bit of money for our charities this year, Make-A-Wish and Wooded Warrior Project. Also, of course, we couldn't have done the event without our speakers, so a big thank you to Dr. Husing, Bruce Norris, and Christopher Thornburg. Unfortunately, we did have a little bit of audio problem near the end, and we lost all the audio for Chris Thornburg's presentation and for the Q&A. So unfortunately, you will not see that at the end of the video. However, we do have everybody's PowerPoint. They'll be posted to our website as of now. So hopefully you enjoy the video, and we'll see you next year at the 2016 Market Forecast. Have a great day, and thank you very much. Good morning. How are we? Great. Good. Thanks to everybody for coming. I was going to start at 9 because I'm kind of a stickler about that, even though I'm late to most of the meetings I'm attending. Anyway, we had a little challenge with Bruce's PowerPoint, but hopefully it's downloading to my Dropbox and it'll be there. Oh, there's Diane with the backup. Hi, Diane. You made it. All right. At any rate, I want to welcome everybody to Ontario and to the Coldwell Banker Town & Country's 4th annual. It's hard to believe this is the 4th time we've done this, but welcome. I'm glad everybody's here. We've got a pretty good presentation, I think. We do this every year. I'll just do it again. Who's here to see Bruce? A couple, 3 of you. Keep your hands up if you saw Bruce a month or so ago at his Proceed with Caution. Anybody? Okay. All right. Well, then the good news is we get a summary of his 8-hour Proceed with Caution deal that he did. How about John Husing? Who's here to see John? Okay. Has anybody seen John speak in the last 3 or 4 or 5 months? Me neither. So it's interesting. And how about Chris Thornburg? Anybody seen Chris? Who's here just to see Chris? Anybody seen Chris speak in the last couple of months? Okay. And you're back for more. You got to love it. I'm the same way. You can never get enough of any of these guys. But at any rate, again, thanks for coming. My comments are going to. Oh, actually, while we've got that on the screen, I'll mention that real quick. We're probably going to do a little bit different this year. In the past, we've kind of discouraged questions from the floor. I don't know how well that works, but at the end of each speaker, we'll take 4 or 5 minutes, and hopefully we'll get some decent questions. So we will take some questions from the floor, and we are going to be having a Q&A. If you can stick around till 12 o'clock. Bruce isn't going to be able to stick with us, but I'm pretty sure John and Chris Thornburg are going to we'll do an open mic kind of thing for about 30 minutes or so at the end. But we will take some questions from the floor. However, if you're shy and you want to text the questions, my cell phone number has been kind of scrolling on the screen there for a little bit. It'll be scrolling again for the next 5 or 10 minutes until we bring Bruce up. And then you can just text those questions into me. And if they're any good, I'll ask them. So we'll see what we can do. So again, I want to thank everybody for coming. Just a couple of kind of the niceties that we got to take care of first. And normally do this at the end, but I'll start at the very beginning. I want to thank my lovely bride for coming. So Julie's here. Thank you, baby. And most of you, in addition to my wife, you may also know my mom and dad. My mom and dad are here. They're the original pioneers. Wayne and Judy Martin are here. So welcome, Mom and Dad. I think this is the first time they both attended this at the same time, so welcome. And I got my boys here somewhere. Drew and Drake are rolling around the back, or I haven't seen them in a minute, but at any rate, they're here as well. And I know we've got a lot of agents, not as many as I'd like, but raise your hand if you're actually a Coldwell Banker Town & Country agent. All right, good. All right, fantastic. So welcome. Anybody who's in the room? Who's a buyer, seller, a client, or not an agent? Who's not a real estate agent of any type? Nice. All right. Excellent. All right. So hopefully we'll have some decent information, and you'll leave here with a better perspective and view of what's going on in the real estate market when you got here. So I also want to thank our sponsors quickly and briefly, and I don't know where she's at, but Jen Seen from Alpha Graphics is here somewhere. Jen Seen, where are you? Oh, there you are. So I want to thank Alpha Graphics and their team. Danny Coronado and Alan Vogan. I saw Danny. I don't know if I saw Alan. Is Alan here? Alan's not here. Hey, Danny, from First Lending Solutions. Thank you very much for your support. And Vilma and her team with Mountain West Financial. So where are you at, Vilma? Vilma right front and center. So I want to thank you guys for all your support and help. And we also have Rhonda and Rebecca here from Make-A-Wish. So hopefully, they're in the very back. They're going to do a brief 5-minute presentation at the end and kind of share a little bit of stuff about what's going on at Make-A-Wish, and hopefully we'll see some support there. And where's Ingrid at? Ingrid out in the back? Oh, there's Ingrid. And Ingrid kind of is our designated representative with Wounded Warrior. Her husband's active duty Marine who's just in the process of kind of discharging and transitioning into civilian life. And Ingrid's kind of brought the Wounded Warrior program to us over the last few years and has done a great job. So those are our sponsors and our charities. And wow, I think I felt a ghost or something. Somebody just walked right by me. Anyway, so I'm gonna keep my presentation pretty much to what I just did. I don't want to chew into Bruce's time or the other guy's time. And I think anybody got a watch in front of them? Where did my phone go? Yeah, we're gonna bring Bruce up here literally in about 4 or 5 minutes. So I will just kind of give you guys the following summary of what I see going on in the marketplace. Who feels the market's improving? Do the people okay, who feels it's not improving? Okay, a couple, 3 of you. All right, and then the rest of you just don't raise your hands when you get asked. I got that. I'll tell you, the market's improving, guys. And there may be some challenges, and I'm sure Bruce and John and Chris will kind of express what some of those challenges are. But for the first time in a long time, there's some real evidence out there that the marketplace is improving. Just in our offices alone, since January 1st, our open escrows have doubled. Actually, they've more than doubled. We're probably up 120% in open escrows just in the last 60 days. Now, for those of you, the market's not improved. Well, those escrows haven't necessarily closed yet. But business is better. Interest rates are still ridiculously low. I'm sure there'll be some comments from Bruce and the gang as far as where interest rates are going. I don't want to preempt Bruce, but I think a month ago he was like, hey, it wouldn't surprise us if interest rates are lower at the end of the year than where they are right now. So be interesting to see how that shakes up. But generally speaking, I'm really excited for this year. And I think if you played the tape, by the way, did anybody watch? Was anybody who was here last year? Okay, is anybody, in addition to those people, who's watched the video of what we did last year? Okay, a lot of you. Okay, if you go back and you rewind last year's video, I probably said some similar comments, and I truly meant, I think 2014 was going to be a good year. Having said that, 2014 started out about as bad as I'd ever seen it. The first quarter of last year was probably the single worst quarter of business that I've seen in my entire real estate career. And the rest of the year got better, but I don't know. I don't think anybody set any records last year. The main difference I see between this year and last is the first quarter of 2015 so far, not too shabby. And I hopefully you guys are seeing the same thing in your business as far as buyers engagement, and sellers engagement, and all the rest of that sort of stuff. But I can truly stand up here and say, hey, last couple months have been pretty good. Frankly, I didn't say that last year. So at any rate, we're going to go ahead and get started. We're going to queue up Bruce. Are you ready or? Okay, I think while Bruce is making the walk up the stage here, I'll try to get his PowerPoint queued up. Hopefully that email came through and we're good to go. Or are you going to use, you got the thumb drive? Okay, we'll queue up the thumb drive. So did we figure out a lapel mic for Bruce, or is he? It's on its way. So it's on its way. So you'll have to either use the handheld for a moment, Bruce, and or the walk around. And and the lapel mic is here. So just give us a few seconds. By the way, we're not professional event putter-oners, so give us a little bit of, oh, by the way, why we're, put this one on them too, if you could. Okay. Put that one on them as well. By the way, gosh, I almost forgot. I was going to say this for the end, but you went to the board. We are not professional event putter-oners. This is a technical term for what we're doing here, right? So having said that, you don't want to do that in terminal server. This could not be done without
This is the other one.
And frankly, the rest of the staff, but I specifically want to call out Casey and Ingrid. They spent a tremendous amount of time putting this on. They literally just kind of show up and that's that. There's a lot of work doing these things.
This must be it.
Yeah, that's going to be.
This one's for the
I don't
gotta put this
This one is.
Casey and Ingrid and everybody else needs help.
The other one's for the This one.
Because,
This is camera.
maybe one day we can go out and put on some things. other than to say, you can read his bio, most of you already know who he is and what he's all about, so you can go through that. Other than to say, his market, proceed with caution. I attended 95% of it, good stuff. We're probably gonna get the best of that. I
95%?
had to leave a little early as a whole other, but I missed the very, very end, so maybe there'll be some surprises here.
Oh,
So,
my
hey,
goodness.
everybody welcome Bruce Norris.
Thank you. I still don't know that this works.
Well, we'll find out in a minute.
All right, well, don't leave with that, I guess is my point.
Well, you got 4 of them.
Oh, we have 4. Okay. Good morning. How many of you have never heard me speak? I guess I start there. Not too many. Okay. While we're looking for the presentation, I'll tell you how a lot of this started. In Grand Junction, Colorado, I'd already been a real estate investor in California for about 3 or 4 years. I had a friend that lived in Grand Junction, Colorado. His dad did, rather. And every once in a while, I just ask him, hey, how's your dad doing? In the early 80s, he was doing great. And then somewhere around 83, I asked the question, and he said, oh, it's terrible. My dad's doing terrible. And I said, what happened? He said, the oil shale closed. And so real estate's really stinky. I said, okay. So I asked him about a year later, and he says, oh, you should go there. You should go buy stuff. And it was the first time I ever thought about getting out of California and also buying in a depressed market. And when I went up there, I thought I would pull a Robert Allen. I ran an ad in the paper, because I was running an ad in the Riverside paper that said, honest investor pays cash for homes, call me first. And so I thought I'd plug that into that market. And instead of getting 50 calls a month, I got 50 calls a day while I was in the Hilton Hotel. And everyone that had a piece of real estate would have sold it to me and given me money. They wanted to sell me their house and give me $10,000 or $5,000 or $25,000, whatever. That's how upside down they were. So I accomplished absolutely nothing in the 3 days except scaring myself to death. And I went back home realizing there's different markets. And what had happened there is they had something that an industry crashed and caused what I call reverse stimulus. And we're going to talk about that concept this morning. Because if you want to know what's going to go on with 2015, you have to realize what direction stimulus is going to go, and that's in a lot of different categories, okay? The idea of stimulus, if you read the definition of market value is the price that will come out of an agreement between a buyer and seller who's equally motivated, equally knowledgeable, and then there's a part that says, and the transaction is without undue stimulus. Okay, so what would be transactional undue stimulus? Would nothing down be a stimulus? Or how about a $8,000 tax credit? Would that be an undue stimulus? Okay, or what about what about a seller carry back 0 interest rate loan for 30 years? Could you sell that house for more than it's worth to somebody else? Yes, okay, so that's transactional stimulus. What the definition of market value never considers is systemic stimulus, which is even more important. So in 2003, 4, 5, and 6, you could go as an appraiser and prove value in Moreno Valley for an 800 square foot house at 300 grand because there were comps. No transactional stimulus, but systemic stimulus helped us get there. Systemic stimulus is very important or very dangerous. And so what did we have? We had stated income loans. So somebody could just literally write down something that wasn't true, and a lender went, I don't care because I'm not going to keep the paper. Systemic stimulus drove that. After it crashed, we had what's called reverse stimulus. So that's what Dodd-Frank is. Can you have systemic reverse stimulus? The answer is absolutely yes. And you can have it in a lot of different categories. So if you look back in our history and you say, okay, well, when is systemic reverse stimulus hurt real estate? What about when they raised interest rates to 18, 19% in 1980, 81? That's when I got started. That's reverse stimulus. If you were a contractor, you went home for a few years and didn't do much. So understanding 2015 necessitates that you look at all these different categories and say, is it going to be undue stimulus or reverse stimulus? And you have a problem. You also have to look at it in the context, okay, year over year, is one thing. Okay, so is 2015 going to be more generous to real estate than 2014, let's say in a category of interest rates or lenders approving somebody that needs credit? But then what about from a historic perspective? So now you have to look at, okay, the whole body of work and say, are we more likely to give a yes answer to somebody in 2015 than we were in the past? So you could have an interesting scenario. You could have 2015 be more stimulative than 2014 in some categories. And then you could look historically and say it still stinks. Okay? If I were you, I said, I'll just make sure I don't not include this. If I were you as a person that gets people involved in ownership, I would have no hesitation at all getting them involved owning a property. You know, I know there's people that actually care if they're making the right decision for their client, okay? What's the deal still of the century right now when you buy? It's the financing, okay? When I got into this business in 1980, 81, I didn't do what you do. I became a buyer of real estate. And I got fairly good at it pretty quickly, and I decided to get excited enough that I quit my job, and I had to get a seed money, so I refinanced my house, and at the interest rate at the time was 17.5. So I really, interest rates have gone up in the last few months, right? And I'm sure I'll see an article pretty soon, oh my, interest rates soar past 4%. And when you have the context that I have, it just makes you laugh. You go, you got to be kidding me. We're going to be concerned about 4% mortgage rates? If you had an existing 4% mortgage rate at any time in the last 30 years, other than the last 2 or 3, somebody would look at you like, oh my goodness, how lucky you are. And now everybody has one. You go, The one thing that we can't afford to think is this is normal. This is not normal. And that's the one thing that, we'll probably talk about a little bit, is that you have to have your eye on some categories that matter. We passed out kind of a test today, just for fun. A lot of you guys have heard me speak before, and it's probably, you already are ingrained so much, you already know these answers. But not to know them is to misinform your clients and make maybe bad decisions. And how many of you guys, when you do a presentation, have charts? I'm just curious. To me, that's the most powerful thing in the world, because people have misconceptions, and you may have them as well. So let's talk about some of these questions. By the way, I think most of you know what we do. The Norris Group is still a purchaser of properties. We probably buy 70 properties a year at this point and fix them and resell them. We do hard money loans to the tune of about $35 to $50 million a year. So we fund other people's deals. So it necessitates us to have our finger on the pulse. We usually have 25 to 40 properties for sale that we own at any one time. And if they don't sell, we don't make any money. And so we're very aware of where the market is constantly, and we also are aware of where the deals come from because of the loan business. We can say that 3-4 years ago it was REOs and it transferred to short sales and it transferred now to something else. And because we understand charts, we can actually look ahead and say this is likely coming and put ourselves in the right place. As a realtor, we'll talk about this, I would definitely be pursuing a certain type of client in a very certain type of way. Okay? And so to me, I would have come to those conclusions by looking at charts. So we'll look at some charts, and our basic business model is we take that house and we turn it into something nicer like that. That's a real transaction. That was a home that sold for something around $356,000 in 2006, and we bought it for a little less than that in 2009, 64, and we fixed it and we kept it as a rental. Now, what's interesting is, how did you get to $356,000 for that house in Moreno Valley? You got there by undue stimulus. How did I buy it for $64,000 in 2009? It got there by reverse stimulus. Everyone was afraid as well. So that property was in the MLS along with about 5 million other ones, all priced way below replacement cost. And as a group of buyers, what did we say? No thanks. We were in the mood to buy one at 356,000, but not in the mood to buy it for 64, and I think that's interesting. And I would have been right there with you unless I can look at a chart and say, I'm emotionally uncomfortable, but I look at this chart and say, this is a no-brainer. Because all I have to do is answer this one question, and this one question came from my experience in Grand Junction, Colorado. I was able to negotiate all of the fourplexes HUD owned in one shot, and I bought them for 40 grand for a fourplex, 10 grand a door for fourplexes that were 3 years old. The only question I had to ask myself was, will they ever build another fourplex in Grand Junction? Because the day they do, my fourplexes will be worth some approximate percentage of a new one. And that's the question. So when you can buy that house for 64 grand, then and follow it with the question, will they ever build one of these in Moreno Valley again? Then you have an answer that says, okay, I'm as uncomfortable as everyone else, except for I think the answer to that is yes. They're going to build that house again, and if I can buy one for 1/4 of replacement, maybe it's a good idea. Okay? That's what charts allow me to do, make very firm, rational decisions in the midst of emotional upswings and depressions. So how did you feel in 05, 06? If you were in real estate, was it just happy stuff? It was happy stuff. And I sold 100 houses that I owned in 2005 and 6 in the midst of happy. Was it hard? Yeah, it was hard. It was a little hard, except for I can look at a chart and go, this is a no-brainer. Doesn't mean it wasn't hard. Because did the prices go up after that? Yeah, they did. And for other reasons that were ridiculous. But anyway, I got to remember, I don't have an unlimited amount of time here. Okay, so let's get to some tests just for fun. Oh. So the first one, if interest rates go up, the following will likely happen to real estate prices in California. So just answer this on your own, and then, so if interest rates go up, the following will likely happen to real estate prices in California. Prices will go up, prices will go down, prices will stay flat, or D, any of the above could happen when interest rates go up. So what's the most logical answer? D or A? A? Yeah, there's a lot of people here that already know this answer, unfortunately. I mean, honestly, the logical answer is A. I'm sorry, if interest rates go up, prices go down. To me, isn't that logical? And that's very well, you talk to most economists, that'll be their instant response. That, of course, when interest rates go up, prices will go down. And they just had 100 economists get together, and that was one of their conclusions. They said, why was 2014 flat? Interest rate went up, so affordability went down, so therefore people can afford less homes, and on and on. So the trouble is, when you put this interest rate with what you know about prices, it tells another story, and that's what's neat about charts, as I don't have to guess. I didn't overlay prices on this chart, and I probably should have, but let's see if I have a pointer here. Do I have a pointer?
Yeah, center button.
Center button. I'm afraid to turn it off, man. There we go. This is sort of when I joined the party. I bought a house somewhere in here for the first time, and then this is interest rates. So if interest rates going up has an effect on something, boy, you would have felt it right then. So they went from 7.5 to 15 between 74 and 80. And what happened to prices? They tripled. So when interest rates doubled, prices tripled. Now we go all the way over here, and interest rates became the bargain of a lifetime, let's say in 2008, 9, 10. And what happened to prices in California? They crashed. So is the formula, if interest rates go up, prices go up, and if interest rates go down, prices go down? Or here's a really good question. If you absolutely knew the direction of interest rates tomorrow, what could you absolutely tell me about the direction of the median price in California? Nothing. That's important for you to know. It's not the most important chart. Okay, now, if you have interest rate hikes, let's say we get past 4 and we get to 4.5, what will happen to the audience of buyers? They're going to get excited to make a decision, because right now they still have the luxury of thinking, well, I'll wait, interest rate's going to go back down. But if it becomes obvious that interest rates aren't going to go back down and they can still get a yes answer from a lender, then you'll have people making buying decisions and getting off the fence, because you sure don't want to see 5% interest rates. Wow, what an ugly interest rate that would be, right? I mean, it's only because we're so familiar with this stuff that we think that's not a bargain at 4.5, but it is. How good are interest rates in this phase of time, this last 2 or 3 years? Leslie Appleton Young, we know pretty well, and she said in a talk, interest rates are at a 50-year low. And I asked her, I called her up, I said, where did you get that? And she said, I got that from CoreLogic. And I called CoreLogic, I said, where did you get that? And they said, that's as far back as our data goes. And see, for me, that wasn't a good answer. So I went to Washington, D.C., to where you can look at archives at the Library of Congress. Microfilm, Sean O'Toole from Property Radar went with me, and for 3 days we looked at microfilm. Isn't that exciting stuff? What we did is we started with a newspaper in 1850 on Sunday, and we did a Sunday every month and looked at advertising for interest rates. And because now I know where interest rates stand, and they're at our lifetime lows. You literally have never seen interest rates like this in our lifetime, which really is important to understand, okay? So when you're trying to sell somebody a house and they start hemming and hawing, please show them an interest rate chart. When would a 5% interest rate be a bad rate? Almost never. So would you hesitate to buy one at 4 when you might get it at 3.5? Is it a wise decision? No. How many Fed fund rate changes have we had in the last 5 years? None. Do you know how many we had the year I joined the party? 21. 21 times during a year the Fed fund rate changed. You're in escrow for 45 days. You had 3 interest rate changes while that escrow went on. So that's what, we have no volatility and we're accustomed to it. That's going to change at some point. And but interestingly enough, this isn't the most important chart, okay? Second question. When houses are most affordable, what happens to the volume of sales in California? So when they're most affordable, volume of sales increases as more people can afford them. Volume of sales not affected by affordability. Volume of sales declines because of inventory so low when affordability is high. Sales decline when homes are most affordable. So what do you think? A? Volume of sales increases as more people can afford them. How many think it's A? How many people don't want to raise their hand? I don't think this mic is this mic working? This one? I can move around a little bit. Can you still hear me? Okay, good. Okay. To me, this is really important to understand, because this is the human nature part of us, okay? The stock market broke all-time records just recently. It went up from where it was, 4 or 5 years ago. If you're a stockbroker, what would it be an easier time to sell stock? Yesterday or 5 years ago when it was flat on its back on sale? What do you think? Yesterday. It's human nature. We buy into momentum. And we do that for real estate too. So this gold line is affordability, okay? So you have extremely high affordability, and remember this time we had in the 90s? Prices were flat or low. This is sales, by the way. So sales volume was pretty flat while we had affordability really high, 40% for years and years. So when do we decide to have this volume spike? When affordability goes down. Is that repetitive? It is. Affordability going down, you spike with your sales volume. Now, how do we manage to do it? First of all, we want one. We just have to have it. As a matter of fact, if they'll let us, we'll have 10. That's what happens. And the lenders drink the same Kool-Aid. Now, if you're thinking about what's going to go on in 2015, there was a very important something that came out yesterday. Okay? It's called a nothing down loan program. Did you guys read that? Yeah. Now, that's not a surprise to me because that's exactly what the market needs to have. You're going to have a need for first-time buyers, and now you have a nothing down loan program. That makes perfect sense. The lenders are starting to drink the Kool-Aid. Now, that's just one lender with a program that's got an isolated group of money for a very particular group of owners, but your competitors now look at that and go, we just lost market share. So what are we going to do? And that's how it starts. So for 2015, if you start having systemic stimulus from lending, you'll be happy that you're here, right? Because that is going to kick up volume of sales. So that was a big deal. So sales actually increases as affordability goes down. And here, though, we have an interesting thing. We have affordability declining and sales declining for really the first time ever now. So when you look at that and say, okay, well, why was that? That was where this idea came up for this report that I just wrote, this idea of undue stimulus and reverse stimulus. Is it possible that you could have reverse stimulus to such an extent that you literally don't loan to enough people and have things affordable, but people unable to take advantage of it? Yes. So that's how important lending policies are right now. Had those 100 economists come out and said the reason why you're having a lousy 2014 is you're literally stopping the sale of so many properties that make no sense to stop. That's what they should have said. If they had the ear of Congress, what they did, that would have been the message they should have sent instead of the nonsense that they did, okay? When houses are most affordable, where would a real estate investor look for bargains? Most affordable. So years like 91 through 95, years like 2008 through 2011, and if you're a realtor and you want to work with investors, this would be where they were. We pursued lender-owned properties and short sales, things in the MLS, okay? So that's important to understand if you're dealing with investors as to where to hunt for deals for them, okay? And in 2008 through 2010, weren't investors a very big deal to realtors? And then you guys still like us or what? Yeah, we don't need them. FHA feels that way. FHA got a big help by investors buying all kinds of stuff, and they thanked us by reinstating the 90-day hold rule, right? Thanks, we don't need you anymore, so go home. But if you deal with investors, you'll find that we buy even in markets like this, but it's a different game, and we'll maybe talk about that. When affordability is extremely low, what happens to construction of new homes? This is kind of interesting. So construction of new homes, affordability extremely low. Sales of new homes decline sharply because they become unaffordable, which would support the theory of the economists. Sales of new homes decline slightly. Sales of new homes are near their peak. Sales of new homes are not affected by affordability chart. So what's the answer? It's C. When the market is hot as a firecracker and affordability declines like crazy, building goes through the roof. Which is, by the way, you never want to ask a builder what's next. Because they built the most homes they could possibly build in 2005? I had a debate in front of the builders in October of 2005. And I told them if I were you, I would sell every house, every lot, every land parcel and buy it back for a song later. And do you know how that was received by the California builders at the time? Like, this guy's got a hole in his head. Because that's not what was happening. And if you judge what's happening by, and you know how they have those things? They have three categories. Traffic coming into their models, that was off the charts, okay? Expectation was off the charts. So everything they look at was very positive because they have no methodology of saying, well, this is about over. So euphoria is where they were, and they were about to be devastated, and they had no idea that was coming. But this is interesting to know that the market has the biggest participation of new homes as a ratio of sales at the end of cycles, at the end of booms. That's what causes problems. Because when you have a crash like we had, the participation of new homes goes up to like 25% of the inventory. And that's too big. You know what it was at the start of this year? Unsold new homes to sales, 1%. So, is it time to build something? Probably. So that's another niche that you might consider. Okay, looking at this foreclosure chart, what would be true about 1989? I guess we ought to look at the foreclosure chart. Trustee sales are very low, so it would be worthless to pursue foreclosures. Trustee sales are very low, so prices would probably be nearing their peak. I'm going to stop there. That's the answer. So this is 1989, and trustee sales are down here. This chart is what I call a reactionary chart. It doesn't invent itself. It reacts to something else. But when it gets historically low, and there are other charts that confirm that this cycle is nearing its end, it's a good telltale sign. Why are prices at their peak when you have low foreclosures? Because remember how messed up the comps were in 2009 and 10? You could fix a house, like somebody like me could buy a house and didn't have a kitchen. I'd fix it up really great. I'd put it up for sale in Moreno Valley for 150 grand. I'd get 24 offers the next day for full price, and the appraiser would come out. Instead of appraising at 150, he appraised it at 109. And why did he do that? Because the only comps that were out there were houses without kitchens. Okay, that was it. He couldn't look at another finished house. So when you have no foreclosures, all you have is finished product. So that chart that shows you what's this type of sales, what percentages are REO, what percentages are short sales, what percentages are equity sellers. Well, now they're 91% or so of equity sellers. And so the motivated seller almost doesn't exist at this point. And that's when prices start to go up. When we buy stuff, and we're in that mindset. Remember in the mindset of 2005? You just knew whatever you touched was going to make money. You put flowers and a little grass in, and you said, well, that's got to be worth 50 grand. And somebody went, yeah, I got to have one, Okay. Looking at this foreclosure chart, what would a year like 1994 tell you? Trustee sales are still rising, so sales volume's probably up. Trustee sales are still rising, so it's a good time to mail directly to people in foreclosure. Trustee sales are rising, so it would be a good time to build new homes. Trustee sales are rising, so I would expect prices to be soft. That would be D. This is a roadmap for what you do as your career, by the way. If trustee sales are still rising in 1994, usually it mimics a year in the past, by the way. So when you want to make a living as a realtor, understanding that this is coming in advance, that this huge pile of foreclosures is coming, is to say, you know what, maybe I'm going to put on my REO agent hat on for a few years. The plaques that you guys have all over the place tell you exactly what to do. So who are the plaque names? Who are the names on the plaque in, say, 91 through 96? It's not somebody that's farming. And those same names appeared on the plaques in 2009 through 2011. And they did exactly what they did before, and they did it in advance because they knew it was coming. They just sat there and went, okay, you're going to... Some of the guys are way ahead of the curve. They literally are telling the lender, you don't have any now, but you're about to get a ton. So let's start a relationship before this all happens. And that's why they were there. They were there already because they knew it was happening. Okay? Okay. I'm going to camp on this chart for a minute and let's see what the question is. Looking at this affordability chart, what would a year like 1989 tell you about California real estate? So 1989 is here. this affordability chart is really important because of where we are right now. And this has been repetitive. There's an interesting, this is one of the charts that I call, this is a domino chart. This literally starts other charts to react. And it always repeats itself so far, okay? Now, this has been around, affordability has been around for a long time. If you're a realtor, you're a member of an association that has this definition. It says that high affordability is equal to real estate well-being. So you didn't know it, but you had maximum real estate well-being in 2009, 10, 11, and 12. Now, how did that feel to you? Now, you had declining well-being from 1998 to 2005 or 6. And if you had owned something, it tripled, and I don't know where your well-being would be better. What do you think? If your prices tripled or got cut in half? So it is exactly the opposite of their take. Affordability declining is equal to real estate well-being, as in you just got rich. And affordability exploding means it's a math formula. Why did affordability explode? Your prices crashed. So if you held that stuff and you didn't know that was coming, that was a sad day. Okay? Now, what is repetitive, by the way, nothing happens with high affordability. You don't induce somebody to want one just because affordability is high. People want one as prices go down and they say, wow, everybody's doing it and everybody's making money. What's repetitive is this low number until here, and this is why this concept of stimulus kind of kicked in for me. This is 17% affordability in 1980. When you hit 17% affordability, what happens is the buyer, who is actually the most excited he could possibly be, goes to a lender, and legitimately they have to say you don't qualify. And if all the lenders are telling you that same story at about the same time, the market dies right there. If you're selling new homes, which we were at the end of some of these cycles, within 30 days it's like, what happened? Somebody pulled the plug. And all of a sudden, everything else, every other chart that matters starts going in the wrong direction. Your inventory literally goes from a mild amount of months in 18 months to maybe 400% more. And if you don't know that's coming, that's a problem. So if you're a new builder and you're in the middle of 4 months of inventory and a year and a half later you got 18 months of inventory, you're not going to sell your stuff at the price you thought, that's for sure. And it's repetitive. So to me, this is a real important number, the 17% affordability number. We got to it in 1989. Now, I didn't know this stuff by then, by the way. I learned the hard way. In 1989, I was euphoric as everyone else. So what did I do? I built 7 custom homes in Palm Springs. Got done with them June of 1990. Anybody have a good memory? How did that work out? Not very pleasant. I had those for almost 2.5 years, writing checks for them every month for a long time, $3,000 a piece. Finally got out of the last one. I traded some of them for, 2 of them I traded for a 60-foot yacht because I thought owning a free and clear yacht would cost nothing monthly. That turned out to be inaccurate as well. My last closing, I had to write a check for $56,000 personally to close it. That's called a personal short sale. And those are very painful. So, I kind of got a kick out of this last cycle where lenders were actually giving them money. I thought, man, that was not around in 1993 for me. I know that. Okay, so I learned to respect this when I did all this study in 95 and 95 through 97, and I wrote the report, The California Comeback, why prices will double in the next 8 years. I really paid attention to the charts, and I said, wow, when this affordability gets down to this number 17, bad things happen. Well, here we got there in 2005, and then we proceeded to go down to 11% affordability. And prices went up, and I'm scratching my head going, okay, what have I been wrong? And then I started looking at, and at the time we did a seminar, and there was a woman that was in the lending business, and we had 400 people in the audience, and I had her up here doing an interview, and I asked her, and I literally didn't know the answer because I had paid everything off that I had in real estate in 05, so I didn't know how silly financing had gotten. And I asked her, stated income loans. I said, where does the number come from? She said, oh, we just make it up. This is a lender. I was stunned. I don't think I asked her another question. I have to think about that. So I went back to this chart and I said, okay, that's what's going on. There's nonsense going on. People are getting stuff they shouldn't get. Okay, that scares me. So the report we wrote in '05 was named the California crash. We did another report in '07, said category 5 with a tornado on it. In other words, this is going to be really ugly because we've had so much undue stimulus that when this turns, we're going to have reverse stimulus in a hard way. So that's why I'm taking time here we are at 30%. And one of the questions that you have on your test is, which is more important, that you've come from 55 to 30, or you have room to go from 30 to 17, basically. The first one, to me, is immaterial, because high affordability doesn't do very much. It's when you have affordability declining that all the excitement to price happens. Historically, do we have room at 30% affordability to have an upside? We do, as long as lending doesn't get in the complete way of saying yes to people that'll pay their payment. That's the one caveat, is that could we have such restrictive policies in lending that you would end up having an affordability number and be higher than normal when it's over. It's possible. But then yesterday, that came out. There's also a federal report that just came out yesterday. You know what it said? He said that the market could actually absorb twice the delinquency rate that it currently has and still be fine. So I just like that. I said, here we go. So it's okay to take twice as much risk, and here's a nothing down loan program. That happened yesterday. So that's where we're headed. We're headed to some more stimulus. Maybe it'll be capped at a sensible point at this time. So I don't expect we'll see this affordability number at 11, but I believe it's human nature to get it to 17, and we do it every time, and we do it on the backs of our own excitement, and we do it on the backs of lender cooperation, and on the backs of it, you know what, it's just the best thing that we can do. We're still borrowing money at very low interest rates. So anyway, all of those things, I think 2015 is going to be a good year. The only thing that makes me afraid, and this is one thing that goes out further than 2015, what happens if you have interest rates where we are or lower, and you get to this 17% affordability number on the backs of an interest rate that starts with a 3 or a 4? See, that's a problem, because when you go forward, you're going to have an interest rate that's going to be different someday. You know, when I was in the business in 1981, very smart people told me, you'll never see a single-digit interest rate again in your lifetime. And now we're at sub 4%, which we literally had never seen in our lifetime. How wrong could you be, huh? Is it possible you'll see a double-digit interest rate again in your lifetime? Yeah. And if you do, then prices will have a hard time going up from there, because you're going to constantly be batting your head against an affordability number when a lender has to say, I know you want it, but you can't qualify. That's how special these interest rates are. There's also a technique I'm going to mention, and then I'll take some questions. How many people have ever done something called a subject to transaction? Okay, how many people have no idea what that is? Okay, a subject to transaction is not against the law. It's not against the law. First, I'll say that it's against lender policy. And what it is in Riverside County, how many people are upside down still? 25% or more? Do you think some of them might want to leave and move? A subject to transaction is basically, let's say you have in Moreno Valley, you have a $200,000 house and a $200,000 loan. And you lose your job and you get transferred, you go into someplace else. What are your options if you own that? List it with you guys. What size check do they write at the end of that typical escrow? 20 grand? 10% plus or minus? Okay. They could default, say, I'm walking, I'm not going to get anything. Or they could sell to somebody that understands what a subject to is. And a subject to is, you grant deed me the property, I'll make the payment and keep the house. I may rent it, I may wrap it and sell it for a higher interest rate. Are there a whole bunch of people that want ownership on this side of the table that can't get qualified, but that would want to own? One of the niches that your brokers could touch is being in the middle of that transaction. There's a lot of people that don't have equity, and there's a lot of people that can't qualify for loans who want to own houses. You put yourself in the middle, and you'll be one of the few brokers that attempt that transaction, but you'll have thousands and thousands of leads. Okay? And all we're doing is we're taking ownership from one owner to the other without the permission of the lender. Okay? There's a way to do it. Investors do it all the time. There's not one investor that I know is afraid of a due on sale clause when it's done properly. Okay? Just a thought, because you're missing out on a lot of transactions. There's a lot of people that could own a home that aren't getting to. Okay? Okay, I'll open up for some questions, because I'm not going to be part of the panel. Is that okay?
Yeah.
Yeah? I can still talk, but
Of course. And our next speaker is hello. Our next speaker. Hello. While they're getting these mics queued up, I'm assuming there's more than a few questions out there. I got a couple questions though. Got three actually.
Oh, for me? Okay.
For you. I think last year, you just hit on it this morning, about affordability at 17%, and there seems to be a magic number at 17%.
Yep.
I attended your Proceed with Caution.
Right.
And I thought you said that maybe you're thinking about changing that number from 17% to something different.
That's because you left early.
Okay.
My final conclusion was what I just said, is that I think that we will find a way, unless you want to create a recession. You know, you need real estate to participate more in the economy than it's doing. We're participating at about 2% GDP less than we usually do. And if you want to say no to everybody you're saying no to now, then you're going to do that. But I don't think that's how it's going to play out. So I really think that, no, I think that is going to, see, you should never leave until the last chapter, man. So I really believe that is what we're going to do. And I believe the human being has it in them to want to do it. That's probably the biggest thing, is that we're very repetitive creatures.
Okay, so if I'm hearing you right, then you're still comfortable with the 17. Who's it? Bruce had mentioned Leslie Appleton Young. If you don't know that name, she's the economist for the California Association of Realtors, has been for a long time.
Yeah.
And I'm on the board of directors at CAR. Has anybody seen any of those meetings or heard them talk about affordability? I'm the only one? Okay. Well, what Bruce said is accurate. I mean, you would think, I was just at a meeting in January down in Palm Desert, and you would have thought that, my God, affordability is the end of the world.
I asked to be on that panel.
You're not welcome.
I know.
That's why we have you here. Okay, so in other words, affordability currently is about 30%.
Right.
Correct?
If you were afraid at 30, you would have been afraid in 2002, 1987, 1977, and then look at a price chart and tell me you made the right decision. The answer would be no.
So we should not be afraid of prices, or affordability rather, being at 30, as opposed to when it was at
Right.
60 or 50.
And
all
the concentration from car is it's gone down from 55 to 30. Like, oh, that's the crux of the problem. No.
Right. Okay, I got another question, which ties in. I got two more, and then we'll open it up to the audience. Just raise your hand, look for Drew and Drake, and they'll help you out. Again, I left early when you did your Proceed with Caution. I thought I heard you say, I think you kind of asked the people in the room, where do we think interest rates are going to be December 31st of 2015? And I think the consensus was higher than where we're at today, which was a month or so. And I thought I heard you say, don't be surprised if interest rates are at 3.
That's true.
Do you feel that way, and why?
You want to know how I really feel? What I talked about just now? I don't care. Because that's not the important chart. It isn't. So if it's 3 or 4, it doesn't matter. It really doesn't. It only matters at how it reflects on this affordability chart. I'm sorry. That's stupid. My phone never rings. That's honestly.
If you have Bruce's cell number, you are in the circle.
But even, oh, you know what? It was my alarm going off telling me my talk is over. Sorry about that. I'm calling myself.
Time up, you're out of here.
Okay, the only thing, okay, cheaper interest rates maybe kick that affordability up some, but it doesn't need to go up some. Does it mean, actually it means to me more danger going out further. In other words, what if we price ourselves out and we have a 3.5% mortgage rate? That's scary stuff. That really is for the future. If you want to know what I would do if our price is pegged at 17 and the interest rates were 3.5, I would exit everything I have that I didn't want to go down or that I cared about going down. So that's how serious that would be to me.
So at a 17% affordability with low interest rates, that scares you?
Well, because going forward, I don't see anything good happening at 17%, but every time, what if interest rates went to 5? You'd have to have a price decline to match 17%. It's just a formula. Okay, so that would be a concern.
Okay, and the last one for me, and then we'll open up to the audience. And again, I left early, but the title of your most recent, full-day event was
Yeah.
Proceed with Caution.
Right.
I'm not getting a lot of proceed with caution necessarily here this morning, so.
Well, okay, and you really did miss the most important stuff, because what I was doing is, what I was doing all day was setting in motion what I was going to say at the end. I'm 62, I think, wow, 62, and I have ceased wanting to be a speculator. Does that make sense? So I really want to be making investments. I bought those Moreno Valley homes at 60-some grand. Those are now worth 225. If I hold those from 225 to whatever number, to me that movement is a speculation. I have made an investment. It went from 60 to 225. There is inventory that I view in the California market that's speculative. How did it get there? Why is that house, and that's 1,200 square feet in a not so good area? Just show you how not so good area it's in. We had a sale immediately because it was in perfect shape. And then the guy went there at the wrong time of the day where there was, something going on he didn't like. And his comment was, we have to cancel this transaction due to riffraff. Now, I have never had a cancellation due to riffraff, but okay, I'm willing to exit that at 225 because I think I'm cashing in my investment. And why did it get there? Because the price was driven there by undue stimulus, driven there by who? Investors. That was the target house that they wanted, okay? Are there inventory they didn't want? There's places in Riverside County, San Bernardino County that have still the effects of reverse stimulus. So
Excellent.
I can exchange that to something that still makes a lot of sense.
Okay, raise your hand if you've got a question. Okay, we got a few, so Drew, Drake, start passing these mics out.
Bruce,
Yes.
I have a question that's maybe a little impertinent, but I do that once in a while. I'm curious why those of us that held our hands up that know how to do a subject to transaction, have done it before, weren't mobbed by the realtors in the room.
Because their brokers probably told them it could be legally a
Right,
problem.
Because the brokers are afraid of it.
Yeah.
And I think most of, well, maybe not, but the subject, I rose my hand. But when I was raising my hand, it was because the subject to loans, I haven't done a subject to since when did they go away? I mean, the FHA used to do loans that you could legally take subject to. I think the last one I did was probably in 92 or 93.
Right. Just so I was in Washington, D.C. in 2009. We did a presentation in front of Fannie Mae and FHA. I'm sitting across from the director of FHA. I said it would be a big help if you would let me just take the loan subject to. He says, right off, he said, I have no problem with that. I said, can you put that in writing for me? He said, no, I can't do that. But he could care less. Why? Because he wants the payment made. He doesn't care who makes the payment. He cares that he doesn't take it back and it's another REO. That's from the top down. He gets it. Now, there was a broker in the 90s that got it, who lives in Riverside, who did over 1,000 transactions that you guys didn't do, subject to, because he understood the niche. So it's there. It's waiting for somebody to own it. It really is.
I'm just curious, for the people that did raise their hands, were you doing wraps, or were you doing the old FHA loans that were still in the cycle that you were allowed to legally do? And when I say legally, you were allowed to have the correct paperwork, so you didn't have to worry about it. So
Yeah.
Who was doing wraps? Raise your hand if you're doing wraps.
Yeah. Back when you're talking about, there was no paperwork other than one sheet. It said, okay, this is the guy that owns it. I'm taking over. There was no assumption paperwork. There was a $35 or $45 fee. You mailed it in. That's the end of that. And no one had liability. The originator didn't have liability. You as the new owner didn't have liability on the loan. The property had the liability, and that's the way California is anyway.
Yep. That's, I think that's how my wife and I bought our first house. If it wasn't our first house, that's how we bought our second house.
That's how I bought my first
And
house.
sold. As a matter of fact, the condo we bought, we sold to my sister-in-law subject to.
Yep. All right.
That was the only way she could get it. Okay, next question. By the way, let us know who you are before you ask your question.
Right. Steve McKee, Rehab Loader. Given the number of tracks that were bought and discounted in the down cycle, do you see wage inflation as a way to start schooling up building because of affordability with wages increasing? And do you think that will in turn school the job market with more construction jobs?
You know, I think it's an interesting dilemma that we've got. First of all, how old are you? I'm just curious.
33.
Are you married?
No.
See, that's your fault. I'm just kidding on that, but in other words, your generation is not doing what we expected to happen.
Well, I bought my first home at 22.
Right, well, you're way ahead of the curve, and I got married at 17, and so there wasn't a chart for that either, but the millennial generation isn't getting married at the same time other generations did. We were expecting somebody to, want to have a house and have kids and all that stuff, and it's happening later. Not that you're not going to get to it, you will, but it's happening later. So that's part of the demand that's missing. That hole is real, but the longer it waits, the bigger the rush will be. So, do you know what percentage of millennials have full-time jobs? 30-some%. That means they're in school. When they get to work, they're going to make some money. I bet they're going to have advanced degrees and they're going to do really well. Well, that's going to mean they're going to afford real estate. The builders, one of the charts that we do in presentation, Riverside County normally is clipping along at between 300 and 400 subdivisions, and for the last 6 years we've been averaging 25. So we're not ready for a building boom in lot creation, but if we get construction to work better, which is still way down, it's still at about 80% less than normal for single family homes, then you'll get migration. And if you get migration, then you'll have all those other things, because construction jobs pay well. So we definitely need the lenders to say yes to more products. Now, if you're a lender, one of the things that was systemic stimulation, if you will, is when they said Fannie Mae will do a 3% down payment loan. Why? Because builders are trying to still build 3,500 square foot houses that didn't sell for $350, they sold for $500. Something like that, or whatever what's FHA's loan balance in Riverside, 350, and Fannie Mae's 417. So anyway, you just got a bump on that product of almost 60 grand because there's financing available. So that's, the builder probably just went, thank you. All right.
Anybody else? Steve, you brought a friend with you and asked a question? Oh my God.
Todd Bayer, Rehab Loan Group as well. Bruce, I was wondering what you think the role of private equity is going to be in this cycle.
You know what? It's a great question. Once again, we were invited back to Washington, D.C. to be on a panel in the room full of billionaire hedge funds. And the meeting was about how to loan to investors, basically. And are they out there? Yeah, they're out there with too much money. They were going to go after the person that had 50 rentals, and then they said, well, we'll do 10, and now they'll do 1. They have too much money to loan to investors, and that money is, this is what I said on the panel. I said, first of all, where were you in 2009? Because, I mean, how many safe loans could you have made with an REO in 2009? Ridiculous. Okay, but they didn't show up till way later, first to buy them, then to loan on them. But all of your money that starts with a B could start with a T, a trillion, if you turned that fund to loan to private owners, occupant owners with nothing down or stated income. And that's where I think it's going to go. They're going to find that all that money they have, could you get an owner-occupant loan at 5% if it was nothing down? Would somebody pay that and still be able to afford it? Yeah, I bet. And I bet they'd have no problem with the payment history. Case in point, when they gave an $8,000 rebate if you bought a home in Moreno Valley in 2009 and 10, was that $8,000 nothing down or better? It was better. How's that portfolio performing? Because you're afraid of nothing down. Did it perform okay? Of course it did, because prices went up. you know, they showed up now, that house they bought for 100 is worth 225. Where are they going to go? Now they got a chance to be a move-up buyer. That's what's missing right now, some common sense.
Let me do a follow-up to that, though. So when you're talking equity, you're talking hedge funds, Wall Street money. Did I hear you say that you think that that money is going to flow to individual?
Well, how did that guy come up with a nothing down program? That had nothing to do with government. That had to do with private money, and that's what they're doing. I remember driving around in about 2000, there was an advertisement that said they will do 125% loan to value. Remember that?
Yeah.
Now, if you're a lender that was,
Turn your radio on without hearing that all day long, and billboards all the way down the 911.
but there was a first person. There was a first company, and they got market share. And when you see, one of the things, when you get market share, what do you guarantee yourself later on? A refi business. So they said, we'll give you a 125 loan to value, and everybody's going, they're out of their mind. 2 years later, they were doing refis because now it was 80% loan to value. They captured market share and they kept it. That's exactly what's happening right now. Somebody that came out yesterday and said, we've got $15 billion is a drop in the bucket. They're going to loan to individual owners at nothing down, but all their competitors look at that and went, wow, that's a good idea. And it is a good idea.
Interesting. Okay, we've got time for one more. I've got what I think is a good question from on my text from Eric Fisher in our Green Valley office. And maybe you answered this, I didn't hear it. His question basically is, what interest rate would you be comfortable with, assuming you could, have it your way, when affordability hits 17%?
Huh.
Well, let me rephrase. That was his question, but let me rephrase it. What would be a healthier market rate at a 17%, considering where are we at today? 4? Any lenders in the room?
Are we that high?
3 and 7/8.
That's,
Got a couple lenders here. What's the interest rate? 3 and 5/8. 3 and 5/8.
yeah. Honestly, how about 6?
6.
See, look at that historic chart and tell me how often you've been below 6%. So that's our dilemma, is that unless we're fighting deflation. So if the world is fighting deflation, you could have interest rates be very low for a long time. And that's why the short term, when you look at what Europe is doing and all that, and the Fed keeps pushing back, well, we're going to raise interest rates, and then they're looking at what's going on and no, they're not. You could have a lower interest rate, but in the short run, it's positive, but in the long run, what we wouldn't want to do is price ourselves out on the backs of that interest rate, where your replacement buyer is qualifying at 6, and they make the same money as a person that got on at 3.5. That's only got one part of the equation to get taken out of, is the price.
So don't panic. Didn't Janet Yellen come out 2 weeks ago, and for maybe the first time in 5 years, said, hey, maybe we're going to do something with Fed funds?
Yeah, but you know what? Just think about, if you have a 3.5 or 4% loan and you can afford the payment and prices go down, what do you care?
Right. Who cares?
Yeah, I mean, in other words, we're not doing silly lending. We're not doing everything that got us into trouble. So if you had a scenario where prices went down, people would just go, okay, so I'm here.
Okay, thanks, Bruce.
Okay.
Give him a hand. We're not going to take a break. It'll take us about 2 or 3 minutes to get John mic'd up and get his PowerPoint queued up. And Frank, I hear the door open and closing it up. If you've had too much coffee, just, the restroom down the hall to the left. So while, by the way, and again, I just, as Bruce is kind of walking off the stage, and before I introduce John Using, I just want to thank Bruce. He's always been available, always done a great job, wealth of information. So again, give him a big hand. Great job. He actually had to move his schedule around a little bit this morning to accommodate us. So if you're going to stay in the room, do me a favor, just try to keep the conversation to a minimum. If you can't resist it, just go into the back. While John's queuing up his PowerPoint, John spoke with us last year. Who saw John? Who was here last year and saw Dr. Using? Fantastic. Who saw him on the video? Anybody see him on the video? Okay. Well, who's never seen John Using speak before? Okay, you're in for a treat. John, keep your conversation to a minimum, guys. If you're going to stay in the room, please. I've had the pleasure of attending multiple lectures and speeches with Dr. Using over the years, and he's very entertaining and fantastic. And I think now that Bruce is a little farther out of the room, he's just turned his head around. Last year I got tons and tons and tons of thumbs up from John. I think it, not so much that his information was better or worse than the other presentators, but he just does it in a very entertaining fashion as well. So, are you guys having trouble with that PowerPoint? What you're looking for? Is it on your thumb drive? Somebody grab Bruce. He walked away with our lapel mics. He's outside in the parking lot, in his car, driving away. Somebody go grab Bruce quickly before he runs off. Okay, while we're killing time here for a little bit, while we're getting John's microphone queued up. Oh, are they up there?
There's a lapel mic.
There should be two of them.
There's two.
There's two. Never mind. He didn't run off. They're here. Kristen, come back. You can set yourself up. So while John's getting his mic set up, I just had one apology to make. As I was walking to the back of the room, both Ingrid and Kristen immediately approached me and said, "What do you mean we're not professional event footer runners?" So I got a little damage control to do there. They do a lot of work on setting this thing up. So, okay, we're going to get...
How do I turn this
I
on?
think you're on. Can you hear him?
Am I on?
You need to put both of them on. Put this one on too.
I have to put two of them on?
Two of them. One's for the microphone and one's for the audio above.
Ah, okay.
Okay, so without any further ado, I'd like to introduce Dr. John Busey. Like I said, if you've never seen him before, it's a treat. And you're going to jump down there on the floor mostly?
Yeah, I need to see the
Gotcha.
thingies there.
Okay, all right. Welcome, John. Everybody give him a hand.
I have to stand down here so I can see what I've got for notes, which are those. I was sort of laughing to myself when they were talking about the millennials not getting married. I got married at 24, 30, 40, and 51. So I tried to do my part. Also, by the way, gave away 3 houses and had to buy a 4th one, so you know how that goes. I thought what I would do is give you some context for the Inland Empire economy and the market as I see it within there for both residential as well as other forms of real estate. The starting spot is always the national economy, because that is the ocean of forces we're all swimming in. In doing that, the first chart is this one. What it shows you is what is going on with job growth in the United States month by month. If you look up here, you see right here the Great Recession. Altogether, we lost in the United States a total of 8,710,000 jobs. Huge downturn. The last time anything like that happened was ended the year I was born in 1941, so if Bruce is complaining about his age, I'm 73. Now, what you see then is 3 really tall bars. So there's a recovery started. Don't get excited. That was the census workers being hired. Then you see 4 negative bars. Don't get depressed. We laid them off. Then you see a lot of job growth. So the question is, where are we now? In the United States, we are up 28.5% above the jobs we lost. So we are out of the recession. There is no more recession in terms of where the employment market is today, up 28.5%. Couple of other major things that are affecting the market. One of those is, as you all know, when you go to the gas station, petroleum prices and therefore gasoline prices have come down significantly. You can see here where they are at the moment They're just a little bit above the low back in 2009, and if it dropped any further, it would go back to all the way to '05 to get where petroleum prices are. Now, this has put downward pressure on all sorts of prices because petroleum works its way into the entire economy. It is helpful for an area like ours for a single reason. We are not a wealthy area. So most families here spend close to 100% of their income. When you lower a major item that most people have to use, which is anything dealing with petroleum, you free them up to be able to buy other things. Now, they're not doing it yet. How do we know that? Because Walmart and Costco and Target, companies like that have not seen a simultaneous increase in spending, but there's usually lags in a major event like this. But this is actually really huge. Next is consumer prices. The Federal Reserve Board would like to see prices where that red line is on there at 2%. Where were we this last month? At minus 1/10. Of course, oil is having a major effect on that, but we are in a very stable price environment. Frankly, too stable. We'd like to see prices going up a little bit. The last thing we want to see is having them go down. Why? Because if I borrow money and prices are dropping, the money I'm paying back is worth more than the money I borrowed, and I'm getting hurt by it. And generally when you borrow, you sort of expect the dollar to get weaker over time, and that's supposed to help you. But this does mean that one of the other things that's important to you is that interest rates, I'll talk about them in a minute. The other thing that's gone with oil is, I don't know how many of you are foreign travelers. I am. And I'm also an alcoholic, so I drink an enormous amount of wine. Now, this chart to me is the most important chart that you will look at because of that. I have a favorite bottle of wine called La Tèche. It's a Burgundy. When this chart was back here in 2000 through 02, when the dollar was getting really strong, a bottle of La Tèche cost $1,500. And my wife permitted me to have one. Then as the dollar weakened and it came down farther and farther in value, the cost of that bottle for me as an American went up because our dollar didn't buy as much of the rest of the world. So as I got down in here, I no longer could have my La Tèche. It got up to over, I think, $2,200 a bottle, and she said, sorry, you don't work hard enough. Now, where are we today? Well, it's back where that top line is at 88.9. It's gotten very, very strong compared to where it had been for several years. Guess what? She bought me a bottle of La Tèche for Christmas. So thank you to whatever happened to make that occur. Now, how does that affect you? This affects you in a major way. If you look at the labels on your clothing and your shoes, if you look at your electronics, if you looked at most consumer goods, a huge share of those are imported, like my bottle of La Tèche, which means everything you're buying from the rest of the world just got cheaper. That helps the Inland Empire because a huge part of our economy is handling goods coming in through the ports of LA and Long Beach and all these big warehouses. And in addition to that, landing at Ontario, say with UPS, or landing over at LAX. So this is positive for our economy. It is negative for most of the American economy because everything we sell just got more expensive to our potential customers. And so manufacturers and people like that, this is not good for them. It is, as I said, good for us in this particular region, unless you're in manufacturing. Whoops, sorry about that. What happened? This is a crucial chart for you. Part of the problem I would suspect with real estate in terms of why it hasn't recovered, despite the fact that the millennials are having sex but not getting married and forming houses. I think there's a few of you in the room, I could hear that just then. The fact of the matter is that consumer confidence really was down in the doldrums. This is normal, 100. Here we are back in '08. Look at it, it's in the 20s, slowly starting to work its way up. So people are becoming more confident. Now, I'm an old guy. I was born in 1941, just before World War II. Now, what does that mean? That means my parents grew up in the Depression. Their behavior as consumers was, for the first 20 years that I was alive, was conditioned by that thought, that things can go to hell in a handbasket, so they became incredibly conservative. They did not buy a house in the suburbs until 1955, when I was 14, going on 15 years old. So for that whole period of time, they're going like this. I suspect there's a lot of people hurt in the Great Recession who are acting exactly that way. They're afraid. Now, why this chart's important is the blue line up there shows that consumer confidence right now is above normal. It hasn't been above normal for years, but it's back up there again, which means maybe that's beginning to work its way out of the DNA of our economy. Let's hope so. This, of course, is very important to you. The bottom line is the 30-year bond rate. I mean, the 10-year bond rate. The top line is the 30-year mortgage rate. You can see they move pretty much in lockstep. So wherever the bonds are going, mortgage rate tends to go along with it. There's some gap between them, and it always has been. But you can see rates are still quite low. Are they going to stay low? As long as prices stay where they are, they probably will. Will the Fed act? Probably before this year is over. What Bruce said is correct. Janet Yellen has said sometime this year they will start the process of raising rates, but it'll be very, very slow. And the reason is there's no reason in terms of prices, at least up until now, to worry about inflation. There is a huge potential for a lot of money to get out there and drive prices up. But that money isn't going out there because it isn't being lent. The banks have basically been sitting on excess reserves throughout this whole period of time. In my business, we have a thing called the liquidity trap, which basically says the Fed wants to encourage the economy by lowering rates. Now, this is a little bit like pushing on a noodle. If the noodle is dry, it works. If the noodle is wet, nothing happens. And the wet noodle is, in fact, the liquidity trap, and we've been in it now for about 6 or 7 years, where the expectations of people who would borrow money is just not been strong enough for whatever the Fed was doing to be able to move the economy forward very fast. Fortunately, it's finally getting stronger. Now, switching from there, that's the national forces. They look pretty good for your industry, and frankly, for the economy as a whole. We're the powerhouse in the world again. I mean, look at what's going on in Europe, look what's going on in Japan, even China's slowing. We're the strongest economy right now out there going. California is not the strongest economy in the United States. Here is a picture of California's unemployment rate versus the US. California's in red. What you see is back in the early 80s, and there may be 1 or 2 of you old enough to remember what happened in 81, 82. In 1982, right in here, the prime rate of interest hit 21%. That's what the most solid company could borrow money at, 21%. You can imagine what that did to the mortgage market. So what happened is you basically threw the economy into a deep recession. The unemployment ran up to 11%, and the Fed did this on purpose. And why did they do it? To scare the bloody hell out of everybody. Why? Because prices were going up 10% a year. Consumers expected it, borrowers, everybody was sort of going like that. I remember it vividly because I was buying a house. I had this great stock. and the day I was going to sell it, it dropped 40 points in one day. So I had to take out a second trust deed right in the teeth of that for a house I just bought. It was either that, I actually took a bath, made the water really warm, got a razor blade and decided, okay, which am I going to do, borrow money or kill myself? But you'll notice the US and California moved together. Now you come over here, 1990 through 1993, 4, 5, 6, unemployment goes up nationally, California soars. Now this is the fall of the Berlin Wall, the end of the Cold War, and all of the cutbacks in defense that went along with that, which fell very heavily on California because Ronald Reagan was a Californian, he was president, he spent the Russians into oblivion on defense, and as a result of that, when we cut it back, we mostly cut it back in California. So you had a huge recession. So ours was much worse than the national. You see a little bump there, that's the dot-com slowdown in the early 2000s, and then the Great Recession where again, we took off much worse than the country in unemployment. Why? Because housing was here. This was one of the places in the country where the housing market had gotten so hot. So the unemployment rate went along with that decline in housing in this state, primarily in the Inland Empire and in the Central Valley. The other places it saw it were Las Vegas, Phoenix, and places in Florida. Now, 5% is what you're looking for. And so you see these things going on in the history. Now, we're currently at the moment at 7. The U.S. is at 5, 6. So the gap is narrowing again, as you always hope it will. If we look at what goes on here, the Great Recession, with all those big downturns, we lost in California 1,066,000 jobs. What have we gained back in the recovery? 1,301,000. So we've gained back 235,000 jobs more than we lost. So we are up 1.6% from what we lost. Remember, the country's up over 25%. We're up over 1, so we've got a long way to go before we're back to anything like how well the country has done. Now, switching then to the Inland Empire. We still are a high unemployment area. Our unemployment rate in December in the Inland Empire was 7.2. I love this chart for a single reason. I have been the most depressing person anybody has known for 6 years. We've always been the highest unemployment rate in the United States of the major metro areas. We aren't anymore, thank God. We're only third highest. But at least we're not highest anymore. So we still are one of the areas with trouble, but we are getting better off. LA is higher than we are right now. Now, if we look at, this is the same thing about jobs that I showed you for the US. These are job growth numbers going back to 84. Notice they're all positive. If you shot this chart over to the wall, when I started teaching in 1964, it would be all blue bars. It never went down. The first time it went down was in 2008. And I've been studying this economy this year for 50 years. So that was unique. It was a housing dilemma that really caused it all, plus the slowdown in the world economy. So in this period of time, we lost a lot of jobs. Now we started coming out. Here we're up 32. Here we're up 46. That was in 2013. These are the preliminary numbers for the Inland Empire last year. They're at 32,000. Now, unfortunately, this conference is one day too soon because all the revisions come out tomorrow. And the revisions are sometimes extraordinary. We know that the revisions have to be made to the data coming out of the US, which is more accurate than EDD. EDD does a survey. So when you read the paper and you see me or somebody else quoted about the economy, we're looking at data that EDD, is California Employment Development Department, is sending us. The problem with their numbers? Very, very simple. It's based on a survey that sometimes is grossly inaccurate. To put that in context, the 46,833 number, their preliminary number was 14,200. So they revised from 14.2 to 46.8. That's a slight revision. Well, we're at 32 now, but if you look at what the feds have said for the first 6 months, we should be up 50. So I'm going to go with 50 because I think that's kind of where this is going to be tomorrow. So you can check me out tomorrow to find out whether I know what the hell I'm doing. But I've already been paid, so I'm sorry it's too late. If I'm right, we lost 143,100 jobs in the recession. We're back then at 131, almost 132. We're back 92% of the way out of the hole, which is not as good as the state, certainly not as good as the federal, but it's certainly the right direction. We only have this year then 11,000 jobs to go in order to get all the way out. I think we're going to be in at around 46,000. That depends on whether I'm right on the 50, so again, you can check me out tomorrow to see whether I know what I'm doing. Now, there's a test. You may not leave this room without passing it. The test is, how does an economy operate like ours? And the answer is, you have to think of a gold mining town in the Old West. Now, what went on there? Guys find gold, which is absolutely useless. Well, you can fill your teeth with it. You can throw it at people. What do you do with the gold? You ship it away, and it brings money from the outside world to a place that until that point had no economy. Now, these guys have money. Now, what do they need? Well, certainly they need food and they need tools. So the same money gets spent at the general store, creating another tier of economic activity. What else do they need? They need entertainment. So you've got the saloon. Same exact dollars moving through. They have other needs, but we'll skip that part. You were waiting for that, I'm sure. I used to run a casino in Nevada, so I have a lot of experience with these things. Actually, it's true. I want to hear some fun stories. Now, what is the economic base? Well, the thing that brings the money here, first and foremost, is, in fact, logistics. It is our biggest sector bringing dollars from the outside world. Number two is construction and real estate, because most of what goes on is money coming in from the national money market. So that's a driver when it's strong. Third is medical care, because most of that comes off insurance or off Medicare, things like that. And then finally, manufacturing could be if, in fact, it was a sector that was growing. And it is not, and that is a problem. And that then drives the secondary tier that is in the modern economy. Retailing, consumer services, local banking, all of that sort of thing. But the key is down in the corner. How are those sectors doing? All right, let's look at construction and real estate. I think one of the most important numbers is this one. This is the share of homes that are underwater on their mortgages in the Inland Empire. It was at 54.9% in the fourth quarter of 2009. Now stop and think what that means. Over half the people with mortgages were underwater. That is a recipe for not a lot going on in an economy. Everybody is frightened. Then it starts coming down slowly, gets to 40% by the fourth quarter of 2013, and then it dives. Dives partially because prices went up. Actually, not partially, almost completely. Or people had already lost their homes, one or the other. It's now down to 15. We don't have the fourth quarter number yet, but I imagine it'll be less than 15. So that means the market is stabilizing. Then there is this, notice is a default. Notice how low they are now. This is the first step in the foreclosure process. And starting in 2013, all the way through January of 2015, the number has been very, very low. It's less than a third of what it was in January of 07, before the real problem became identified. So again, we're seeing, even though people are underwater, they are in fact staying current to a large extent. There was only a little over 1,000 homes that were noticed as a default January this year. One of the issues that jumped into the economy, and one of the things that powered prices, was the fact that you as agents never saw a lot of the foreclosures come on the market. They went directly from the lenders, and the deals were cut with Wall Street to buy them in bulk without them ever going to the market. What share of that occurred? Well, it got all the way up. In 2013, it was over 55%. It's now at 29, so it's worked its way down, and it's 29% of a relatively small number of foreclosures. So that, again, is not being the major fact going on in the market the way that it was. Now, prices have been a key player in all of this. These are from DataQuick. The existing homes peaked at 389, 437 in the new home market. Those are back in the 06-07 period of time. Then you see prices collapse. 155, 319 was the low for existing homes, 268, 155. I think that was for the 3 houses that sold new that year. Now, it is now going back up, and you can see it went from 155. In the fourth quarter, it was at 269. So it's gone, prices have gone up 71% from the low. Well, this is great. That is one of the reasons why the number of people underwater has gone down. At the same time, we do still have a problem in the market. In terms of we still are 31% from the peak. But we don't have to get back to the peak to be out of the hole, because a lot of the people who bought at the peak haven't got those houses anymore. That's where a lot of the foreclosures occurred. Now, this is a problem we face in the new home market. If existing homes are going off at 269 and new are going off at 372, and I'm a new home builder, I'm competing with houses I know I'm 38.4% higher than those houses. Now, what's good for me is there aren't a lot of them, which is good news. Otherwise, you wouldn't be seeing a recovery going on as you are now finally starting to see. The thing that has driven this market throughout my career has been this chart. This is a chart showing the relationship between what are prices in the Inland Empire at the median, half above, half below, for new and existing combined, compared to LA, San Diego, and Orange. San Bernardino, 255. Riverside was 305, so on the average, Riverside is 50,000 higher. But look at the prices in the coastal counties, 481, 488, and then Orange County, 678. Now stop and think of what that says. Half the houses, 678,000 above. Half the houses below that number. But that shows you a market that is already gotten almost completely unaffordable. So what do you save if you move to San Bernardino County? 226 from LA, 233 from San Diego, and 423 if you move over from Orange. Take 50 off of each of those numbers, so what are you looking at? 176, 183, I can't do the math in my head, but 50 from 423 is 300 and something, high 300s. So you have a huge advantage to migrating inland. That has driven the Inland Empire forever. I always laugh when I listen to planners and people like that saying, oh, we have to do something to stop sprawl. With that chart, you're not going to stop anything. People will migrate once they get over the fear factor, because if they're going to live in houses, they've got no place else to go but here. And I'll comment on a little bit about that in a minute. Now, this is affordability. Affordability in Orange is all the way back down to 20%, which means 80% of people in Orange County at Orange County incomes cannot afford the middle-priced Orange County house. 80%. It's at 25% in both LA and San Diego. So 75% cannot. What is it in the Inland Empire? It is 47. Perfect is 50. Half the people can afford half the houses. So we're just a little below that. San Bernardino's a little over it. Riverside is a little below it. But 47 is what that affordability factor is here. So our houses are, that's for us. Now take people in Orange with their incomes, more than 47% would be affordable here. Same coming out of San Diego. LA, the incomes are about the same. Now, all that said, the market's not moving. You know that as well as I know that. You see that line? It's almost horizontal, but it's actually horizontal and still slightly negative. So sales are not going on. These are seasonally adjusted numbers comparing quarter to quarter to quarter, and it really shows the market has not really picked up. Now, a piece of the problem has to do with credit standards. These are credit standards on mortgage loans that your bank categorizes as, these are essentially conforming loans. What do we see here? Right in there. This is in January. So over the last 3 months, before January, what did banks do? 84.4% did nothing to their credit standards. Eased somewhat, 14.1. Not a lot of easing going on. Now, looking at this, these are FICO scores. Percentage of closed loans with an average FICO score below 700. 30% were below that in January, 32 the previous year. So the number of FICO scores on loans that closed actually was lower for loans for scores under 700 this year than last year. Not good news. The average score for closed loans this year was in January, 731. That was up 5% from the number of 2014, the average for the whole year. So credit does not appear, at least within the formal organizations, to have loosened. Bruce had some rather, I thought, interesting comments on where the private sector may go in order to fill that growth, the private non-institutional sector. Now, permits, there's a little bit of hope out there. We will get the second half of 2014, but for all construction permits, 3.7 billion. It's higher than it was here, but remember, prices went up, so that really doesn't tell you much. The fact is, it's recovering, but ever so slowly. Now, why the low volume? I think there's less foreclosures, and that was a driver in the market. Buyers want, I should say sellers, forgot to change this. Sellers want or need high prices. Credit has been hurt by a lot of people by foreclosures. The higher FICO scores. The FHA did something that hurt this market. You saw what the price was, middle-priced house for our area for new homes. It was over $350. FHA lowered the threshold from 500 to 300 and cut out over half the new homes in this that are built in this region. It was a national decision, but it was a stupid decision when you have markets that are not national, but rather regional in scope. In fact, we're back in Washington this next week with the IEP talking to Congress about trying to get them to take some action on this. And then the last is what I talked about with my mother and father, fear. People are afraid. There's one other element I forgot about, and that's these people who don't get married. Throw them out. Now, there are things that are starting to help. FHA lowering the PMI from 135 down to 0.85, that's good news, it helps. Interest rates staying down, and Freddie Mae and Freddie Mac now beginning to loosen a bit on what they're willing to do. So there is some good news in terms of where this will go on the credit side. Now, if we take a longer view, one of the things that I'm now living in purgatory. halfway between heaven and hell, because I have to spend a lot of time with planners. And I hate planners because they absolutely believe they understand where the world is going. And they are the dumbest group of people I've ever met when it comes to economics, because they never took a course in it. They absolutely believe that every young person alive wants to move to downtown LA and live in a high-rise or into downtown Anaheim or wherever. Well, here is a survey of 1,600 millennials that was just published in the Wall Street Journal. 66% want to live in the suburbs, 24% in rural areas, and 10% in the city center. I have sent this study to virtually every planner I know and told them to shut the hell up and sit down. Why? Because they want to have more space. If you're alone, if you're single with a couple of roommates, or if you have no kids, living in the city center, fine. Once you have a family, you want out of there. The other thing, by the way, is another survey that applies to me personally, and that is, what are senior citizens doing when they retire? They are not moving into attached housing, they're buying bigger houses. That was the biggest single thing the study found. 33% were buying bigger houses, 16% were going downsizing. So this whole idea that we're all going to go live in boxes is nuts. Why? 81% wanted 3 or more bedrooms in their homes. So this really shows maybe where the market's going to be going. One of the problems you have with downturns, and I've been through 5 of them, is you tend to over-forecast what's going on when you're there. Because when you're under pressure, you do weird things, and weird is not normal. And you're going to see this unfold. It's taking a little time, but it will. Why is this important? These are the loss of construction jobs. See all these negatives in here? Those are construction workers getting laid off. This is what's come back, including my belief that the EDD data is wrong. Now, what's it show? That's what's actually in the EDD numbers right now. If we look at this, using my numbers, we lost 68,433 construction jobs. That's a lot of jobs lost in a sector that pays really well. We've gained back, including my guess of a bigger number, only 13,286. And Bruce said this a while ago, we're still way in the hole. We're down 55,000 out of the 68 in terms of where construction was. The median pay in this sector, 51,933. We need those jobs back, or at least a significant share of them. Very important to us. Now, to switch over to some other parts of the economy. And to sum all that up, what do I think the market's going to do? It's certainly going to be stronger this year than last. 16 will be better. Sometime in 16, 17, we're going to be going, this almost feels normal. When we get to 18, the developers will start to go crazy again. By 19, they'll be completely berserk. By 20, we'll probably have another problem. That's exactly the history I've watched for 50 years. Now, let's talk a little bit about the overall economy as it affects another form of real estate, and that is the industrial sector. 40% of all the goods entering the United States by ship come in through LA and Long Beach harbors. 40%. Who's second? Who cares? Second place is so far behind that it doesn't even count. Now, here's what's going on with the absorption of industrial facilities. What you see here is, this is net, about 12,500,000 square feet being absorbed. It takes off and soars all the way up to 48 million a year. Then it slows. Here's a recession. It goes down, comes back up, and we're right here now at about 17, 18 million square feet of net absorption. So what? That is more absorption than the construction of new facilities from Houston, around Florida, all the way up to Maine. That's how big our market in industrial is compared to the rest of the United States. Right now, we've got 16.9 million square feet under construction. That whole area of the United States, on the coast, thinking the Panama Canal is going to help them, is at 13 million. So we're more than that whole part of the United States in these two counties. Now, see that 7-8 figure? Right here. Last year, 7.8 million 20-foot equivalent containers came in through the ports of LA and Long Beach. It was the third highest on record, and that was in the teeth of the slowdown that went on for 6 months at the ports. Then they got into strike mode, and in January it fell down to the annual equivalent of only 5.8. Now these will jump back up again now that the port strike is over. Similarly with exports, 3.5 million exports down from 3.6, dropped to 2.8. Again, it'll kick back up again. Now, this is hugely important because when the stuff comes in there, where does it go? Some of it leaves Southern California immediately, but a lot of it comes out here. It creates jobs in the Inland Empire for people that are basically making $44,000 a year, which is the median income in the warehouses. Now, question for all of you. You're fairly young, so I think I know the answer. Who didn't buy something online this year? Raise your hand. One guy. His American citizenship is forfeit. The fact of the matter is, we've changed the way we act. Now, for people who don't like warehousing and don't like trucks, none of you can make that statement for one reason. You're the reason. Because what happens when you buy online? You have to build large warehouses in a place that has lots of land in order to serve all those consumers. Well, with all due respect, where do you build them? Here. You go find 52 acres of flat, undeveloped land in LA, Orange, or San Diego County, and the fact is you can't. It has to be here. So if you're wearing any imported clothes, if you're wearing imported shoes, if your electronics are imported, or if in fact you're buying online, you're the reason why logistics is so strong here. I love to tell that to the people who want to fight logistics. This is what's going on in e-commerce. Nationally, it is growing at 15 to 20% compounded. Can you imagine making that on your 401k? That's how fast it's growing. And it's only up to a little under 7% of all retailing. It's probably headed into the 30s, certainly in the lifetime of most of you, maybe not for me. Now, this year, it looks like we've created, again, my numbers, not the official numbers, about 8,300 logistics jobs. It's our second most powerful sector. It is in the economic base, unlike eating and drinking. By the way, I think the drinking is so big, frankly, because of the recession, but that's another whole question. In 2013, it was 18.8% of all our direct job growth. It was 15.5% so far in 2014. We'll see the revisions tomorrow. I think it'll kick up, probably look a lot like last year. Median pay in the sector, round figures, $44,000. This is middle income work, and it's the kind of work that builds customers for people that sell houses. Now, manufacturing could be a source of growth. Why? Well, it could be for us for a single reason. We have a huge labor force that is blue collar, that will work for a little less so they don't have to commute, and our facilities are much less expensive than the coastal counties, and they are newer. But it isn't growing. Here are the data for the U.S., seasonally adjusted, from January of 2010 through to December of 2014. The U.S. created 848,000 manufacturing jobs. California created 12,300. So nationally, it is growing over 7 times faster than California. We only represented 1.5% of national job growth. What you are looking at is regulation in action. We have basically destroyed this sector in terms of its growth in this state. Part of it, you can see, I don't care how many of you are green. If you're all green, hang me when this statement is over. But the fact is there are downsides to whatever policies you put in place. Now, California has a policy. 30% of all of our energy must be renewables. Hooray, we're going to save the planet. All right, this is the cost of industrial electricity in California versus all of the western states. You see that number out there, $11.33 per kilowatt hour? Second most expensive is North Dakota. We are 49.5% more expensive than the second most expensive electricity west of the Mississippi River. Now, you're a manufacturer. You know that chart. Are you going to come to California? Are you going to put your growth in California? You may not leave, but you might leave. The fact is, now Jerry Brown, wonderful governor, used to know him. By the way, I used to run Democratic political campaigns for a living. I did it for 20 years. I put 5 people in Willie Brown's caucus back in the 80s. I was an absolute killer as a campaign manager. I am now a registered independent. Why? Because Jerry wants to take it to 50. Fine. Basically, who gets hurt? It isn't the companies. They can leave or not come. Who gets hurt are the workers who, by the way, happen to be constituents of the Democratic Party. I find this very strange. So the regulatory mess has really hurt us. Now, here's a typical example. Nestle's to close Valley Food Plant. 360 California jobs will be lost in hot bucket production, which is going to Kentucky. The last time said the trend in California has the potential to leave low-educated workers behind. So we go out and we survey executives. What do you think of California? They rank it 50th. We go out and serve small entrepreneurs. How do you rank it? 50th. Those numbers have effects. Unfortunately, the gurus who live in Sacramento, and I swear to God, believe that San Francisco Bay Area is the norm of the world, don't see this or care about it. And who gets hurt are areas like ours, because we have that kind of a labor force. So last year, even with the increase I'm putting in here, we added 938 manufacturing jobs, a drop in the bucket. That's out of my estimate of 48,000 that I've got in here. The median pay, really good. Now, in terms of commercial industrial loans, what you see is the spread between what banks are paying and what they are charging. They're easing, and that's good news for commercial and industrial lending. That's for loans of under 50. For over 50, you're also seeing some easing going on where they're not charging as much over what the cost of funds is to the banks. So that's good news for that sector. But you've got to be aware of the regulators. EPA, CARB, AQMD, whichever one you want, what they are doing is, who are they attacking? They're attacking manufacturing, which you just saw is not growing. They're attacking logistics because they don't want the trucks coming to the Inland Empire anymore. By the way, our most important growth sector they want to shut down. Then the NIMBYs love CEQA, so construction is always having trouble. And who gets hurt are not the companies so much as the workers. You're shutting down the ability of workers to get to the middle class. So poverty is exacerbated as a result of policies largely emanating from my former party. So am I a Republican? No. Am I a Democrat? No. I hate everybody. This is an ad that I just put together for the first piece of good news we've had about logistics in a long time. A study funded by CARB and EPA shows that there is virtually, with the new truck engines that are required next year, no cancer risk at all. It's been eliminated with the new engines. So the technology has worked. And the other forms of pollutants that come out of truck engines are reduced by over 90%. Hugely good news. It is also something you've heard nothing about. Why? Frankly, because the people who want to regulate us to death don't really want this discussed, because it's a huge change that's going forward. Finally, looking at the last piece of the puzzle, skilled workers. Look at these home prices in the fourth quarter. All over 400,000. In the case of Chino Hills and Claremont, up over 500,000. This is where the high-end labor force for the future of the Inland Empire is migrating. This will ultimately allow us to have higher-end jobs migrate here. You needed to get the workers before you could get the jobs. There's a little bit of it down in Temecula, Murrieta, but you'll notice there's about a $100,000 difference in the prices. And there's a little bit of it where I live over in Redlands and in Loma Linda. But fundamentally, it's an arc from Rancho around through Corona, where the really high-end parts of the market exist and where you've got the migration out of Orange, the migration out of LA, and then down in Temecula, Murrieta, up out of San Diego. What we've seen is an increase of almost 3/4 in the number of people living in our region with bachelors and above. Now here's the problem. It's only up to 19% of our population, our adult population. Why is that a problem? Because it's in the high 30s in the coastal counties, and that's who we compete with. So high-end firms are somewhat reluctant to migrate here because of that. This is what we saw in the office market, the other piece of the major real estate market. What we see here is it soared and then dove with the recession. A lot of this had to do with the shutting down of the residential real estate development market, which was taking a lot of space. But a lot of it was also companies that had moved here. One of the numbers you need to know about your region. We have 4.3 million people. So what? We are the 26th largest U.S. state. If we could carve us off from California, and then I could be elected U.S. Senator from the Inland Empire. The fact is, you have a huge state here. We are 35,000 people short of passing Kentucky, in which case half the U.S. states will have a smaller population than the Inland Empire. Huge market. So you would think all the office people would be coming out here to take care of us, and they started to. That's when office absorption shot up. But what happened in the recession is they all retreated back to the coastal counties. So my financial planner who was in Riverside is now in Pasadena. My accountant who was in San Bernardino is now in Orange. One of the others, my lawyer moved to Newport, consolidated back. That will reverse again as the population dynamics. Frankly, you guys are the key. So vacancy in office has come back down as the market has begun to recover, but it's still very high, and so there's really no activity in terms of construction. These are the key sectors. The most important one is in yellow there, manufacturing and professions, adding jobs. That's good news. You want that sector to strengthen because they really pay well. These greenish sort of things show the pay in those sectors. They go from 56 to 67 at the median. We'd like to see a lot more of that, and we will, and it will be essentially in the West End. Now, the last thing I'll talk about very briefly is the retail piece of the puzzle, which is that secondary tier. What you see is retail sales in 2014 look like they set an all-time record. So they've gone into the doldrums, come all the way back. Now you have to understand these data are not adjusted for prices. So the volume of goods is not at a record, but the dollar value is. The problem is you had 15% inflation, so you're 6.1% above the peak, but inflation was 15.2, so you're still got some, you need to happen. Now, this is what I showed you a while ago. It looks like this year we will have created 50,000, in 2014. I'm estimating we'll be in around 46 to 48 next year. Sorry, this year, I always think this way. 2015 is the new year. I think we'll be at 46. This is what the data from the Bureau of Labor Statistics showed for the first 6 months of this year in terms of job growth. Los Angeles added 87,000. We added 52,419. This is not 6 months, it's June of June. June of this year, June of 2014 versus June of 2013. The Inland Empire was up 52,419. That's almost San Diego and Orange combined. That's normal for us. We have normally grown faster than those two coastal counties and almost been the sum of the two. So we're getting very close. So to sum up, construction is returning, logistics is very strong, manufacturing weak, healthcare is set to take off. Obamacare is driving a lot of demand, plus all of us who are old. One of the things you learn when you pass 70 is every year they take away another part. The office sector is modest. Population groups, retailing, consumer services are doing better. Education is growing. Government is crawling. This year, I think unemployment will drop to about 7.9 in our region for the whole year. Growth is starting to look normal, and we only need 11,000 jobs this year to be out of the hole, and we'll definitely get them. I thank you very much. It is always a great pleasure to be here.
I'm over here. I should probably know the answer to this already, but are you staying for our Q&A?
Sure, if you'd like me to.
About an hour from now.
About an hour from now. I'm not sure.
Okay, well, then let's take this, in case he's not here, let's take this opportunity to see if we've got some questions.
I have to check my email to find out if I have a meeting or not.
Okay, raise your hand if you've got a question for Dr. Husing.
I've exhausted, well,
Todd, out in the middle. Drake, get a microphone over to Todd real quick. While you're doing that, I think I have a text from somebody. Oh, the other microphones are up here. Hold on a second. Somebody sent me a text. Was that you, Craig? Yes, Craig. Probably should practice this. Dr. Husing says we have added back more jobs than we lost during the recession. How many more people have been added to the workforce since the population grows over time? And is that showing a healthier unemployment rate?
the answer to the question is there are two measures of unemployment. In my business, what we call U3, which is the number you always hear all the time. The other one is called U6, and it includes people who have dropped out but really want to be in, but just didn't happen to look for a job during the month when the surveys were taken, things like that. People who are on part-time but would like full-time work. When you look at that, it is down, but it is still in double digits. So is it totally healthy? Absolutely not. Is it improving? In all cases, yes. Do we need to go farther? Yeah. One of the reasons for a lot of the dropouts, remember, the oldest baby boomer is just about to turn 70. They're born in 1946. That's my brother, is just about to turn 70 in 2016. So you're starting to see a lot of retirements affect the population that's in the workforce as a consequence.
Okay, great. Now we've got a question from Todd, but before we do that, where's Kristen? Well, I know there's Chris. Can you go grab, you have your thumb drive, Chris? Grab that thumb drive from Dr. Thornburg and get him plugged in while we're answering a couple more questions. Also, before we give the mic to Todd, I saw a lot of people taking pictures of the PowerPoint. I haven't asked permission, but you have no problem.
Of course.
Okay. We'll get you the PowerPoint for Bruce and for Dr. Husing and for Dr. Thornburg, which, did you put yours on your website as well?
I have mine on my website.
I don't know that Bruce does that, but I know I've been following Chris for a while, and every presentation he does, he posts within a short period of time. And you can go take a look at all their stuff. Anyway, we'll get you all the PowerPoints, we'll email them all out to you here in the next couple of days. Okay, question, Todd.
John, you were talking about jobs created by manufacturing in the Inland Empire, but I'm curious about manufacturing output.
The output is up. Employment is basically horizontal. When you take a sector and you put it under enormous cost pressures, then what the manufacturers are going to do if they can stay is they have to become more efficient. So they turn out more with the same or fewer workers. And that's essentially the California story. when I was talking with the folks up in Sacramento and showing them that chart that I showed you about the lack of job growth in California, they said, yeah, but output's up. To which my reaction was, coming from the Inland Empire and worrying about a population that's marginally educated, I will tell you, I don't give a damn. If you're not creating jobs for the kind of workers who live in the interior of the state of California, then why do you call yourself Democrats? They had no answer for that.
Okay, anybody else? Front row? While we're getting the microphone over there, I'll just tell a quick story. Where's my microphone runner? Bruce, right? Come on, jump on this. Just really quick, I was out to dinner, and I was embarrassed to say I didn't know this. Home for me is Riverside, but home office for years has been Moreno Valley. And I had heard for the last year or so, hey, Amazon's building a distribution plant in Moreno Valley, and I'd driven by several months back, and just a bunch of clouds of dust and steel and concrete. One night I was out to dinner with my wife and my son a couple months ago, at one of those hibachi bars with 6 other people, and all 6 of those people worked at the Amazon distribution plant, which had already been opened, which I must have missed the grand opening email. And they're employing 3,000 full-time people. Literally less than 2 miles from home office, if you will.
Well, one of the keys in logistics is the knock on logistics facilities is they're very big and didn't have a lot of jobs in them. The advent of e-commerce has flipped that entirely because the number of square foot per job is on a par with or even less than in manufacturing. So it is, and so you've got a tremendous number of jobs. That facilities, they've got another one in Redlands and they have 3 in San Bernardino. But it's not just Amazon, it's all over the place now. You are not going to be able to see another large shopping center with big anchor tenants in the future. They're just not going to do it because of exactly the answer, except for the one gentleman who we've taken his citizenship away from. Because that's the way we're acting now. I mean, my wife, that's what she does. She buys online, except for her personal shopper at Nordstrom's.
Okay, we've got time for one more question before we bring up Chris Farmer.
Hi.
Planning of Keller Williams. I was a little confused about your statement about the 19% of the Inland Empire population has a bachelor's degree, and that being the reason that companies wouldn't come to our area. You would think there's plenty of people out there that would want to come here if their job was here. So how does that work?
Essentially, the way in which Southern California has grown up over the 50 years I've watched it is you've got to get the labor force there before the companies will migrate. There is a chicken and then the egg. And we're competing with Orange County, where it's 37, 38%, San Diego County, 36, 37%, LA, it's 30%. So if companies that are high-end are going to look for a location, they're going to look for a location where they can find the kind of workers that they need. Perfect illustration of that is Esri, SRI, in Redlands. There are 2,000 very high-end GIS programmers there. When you talk to Jack Dangerman, whom I know pretty well, who owns it, he tells me he has all kinds of trouble recruiting because he's got to bring in a labor force that can do that kind of work. And frankly, they really do want the sorts of things you can find in LA and in Orange County, not out here. And so it's a huge difficulty. So it's that competitive difficulty. Ladies and gentlemen, thank you very much.
Thank you.